Hi friends, if you are thinking to invest lump sum money in mutual funds or stocks, for example 1 lakh rupees or 5 lakh rupees or even 20 lakh rupees, please do not make the mistake of investing all your lump sum money in one go because you are going to regret it. And this is especially when the markets are all-time high. Please make sure you are not investing your lump sum money in one go. Why? Allow me 2 to 3 minutes of time. I want to present to you some live data example. What you see on my screen is that back in October 2024, just before October 2024, Nifty was all-time high. And at that time, Nifty had crossed 26,000 level. Even if you invested in any mutual funds at that time or even in Nifty index mutual fund, then you would have invested at all-time high level. In the next 6 months, so if you look at by March 2025, Nifty fell down by almost 22,000 level, almost a 15% decline. When in September or October 2024, market was all-time high, nobody really thought that market could fall by 15%. At that time, everybody was bullish about Indian stock market. People were saying that Nifty is going to make all-time high of 27,000 level or 28,000 level and whatnot. Everybody was in euphoria, and that is where a lot of people invest lump sum money thinking that market will continue to go up. But you know what? Here, market fell by almost 15%, and people who invested lump sum money at all-time high level would have immediately lost a lot of money, because when they will look at their mutual fund portfolio, all of a sudden they will see 15% drop in my mutual fund portfolio. Have I done the right thing or not? Now you may have a counter argument that, Rahul, it doesn't really matter because it's all short term. In the mid to long term, markets will recover. For example, here after March 2025, market in fact recovered. I 100% agree with that. But please understand that your mid-term returns will also get impacted. It is not just about short-term returns. Let me prove it in next 1 minute. So let us assume that on 26 September 2024, when Nifty was almost 26,000 level, you had invested your lump sum money. Let us now assume that whenever Nifty hits 35,000 level, let's assume for the sake of discussion here that it's going to take 3 years of time. Your return, if you invested at 26,000 level, are calculated at around 10.4% annual returns. Now, if you did not do lump sum investing at that time, and instead of lump sum investing, if you did something called as systematic transfer plan, STP, which I will explain to you in this video in terms of what is it, how to set it up. But essentially, when you do STP, what happens is that you accumulate mutual funds or stocks or whatever on an average buying price rather than buying at one single price point. Let us assume that you did STP in September 2024 and you build positions for the next 6 months. And let us assume that your average buying price comes out to be 24,000 level. Now, if you calculate returns for 24,000 level, assuming Nifty again hitting 35,000 level, let's assume in 3 years of time frame, your returns here will be 13.4% annual returns. So even during the 3 years time period, your returns were better. Why? Because you did not buy or you did not invest all your lump sum money in one go. Rather than that, you set up something called as systematic transfer plan. So please make sure whenever you're investing lump sum money, you're not investing in one go. You have to follow systematic transfer plan. Last argument you may have is that, Rahul, what happens if the markets are down? Isn't that a good time to do lump sum investment? Well, my counter argument to you will be, do you know when markets are down that markets will not fall more? We don't know that. We do not know whether markets will fall, whether markets will go up. Therefore, sensible investors, they like to invest in stocks or mutual funds or whatever asset over a period of time. And for that, the concept that you need to learn today is systematic transfer plan. Allow me some time. I will exactly show you how to set up a systematic transfer plan. By the way, I have not introduced myself. If you do not know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. If you're new to my channel, please do not yet subscribe. Watch this content for a few minutes. And if you like this content, become a lifelong subscriber. With that, let me now show you STP. So what is systematic transfer plan, STP? I'll actually show you practically, but let me make the concept very, very clear to you. So systematic transfer plan is set up into 2 steps. Step number 1 will be that whatever lump sum money you wanted to invest, for example, 10 lakh rupees or 5 lakh rupees, whatever it is, first step will be to put this money into a source mutual fund. Okay. Step number 2 will be that from this source mutual fund, we will set up a transfer plan, automatic transfer plan, and your investment will automatically move into target mutual funds on a set frequency. This frequency could be monthly basis. So every month, money would move out from the source mutual fund to the target mutual funds that you already hold in your portfolio. And more importantly, you can set the allocation whatever you want. For example, if you want a target mutual fund to have 20% allocation, you can set that up very, very easily. I will show it to you in a minute. Now, the advantage of this approach here is twofold. Number one is that you are not investing in these target mutual funds in one go. You are buying it on a frequent basis so that you're buying at an average price. And I explained to you why it makes a lot of sense to buy at average price. The second important benefit here is that while putting this money into source mutual fund, what you have done is this money is not sitting idle in your bank account. Because typically in the bank account, savings bank account, you might get only 2 to 3% of annual returns. But by putting in a source mutual fund, your returns might be slightly better. It depends on what source mutual fund you choose. For example, if you go for overnight debt mutual funds, historically, these mutual funds have generated somewhere around 6 to 7% returns. Again, these are not guaranteed returns, but debt mutual funds do not have huge volatilities, because if you are investing in an overnight debt mutual fund, the overnight debt rate is almost very, very stable. It does not really fluctuate a lot, right? So the second benefit here is that your lump sum money that might have been sitting in a bank account and only generating 2 to 3% annual returns, here you are likely to invest that in an overnight mutual fund, and that historically have outperformed savings bank account returns. And the third benefit is that if this money lies in your bank account, there is a chance that you might overspend. So by blocking this money into a source mutual fund, which could be an overnight debt mutual fund, what happens is that you are not likely to overspend this money. I hope this concept is very, very clear. Now let me practically show it to you how to go about setting up a systematic transfer plan so that you can follow a step-by-step process. Before I do that, so far if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content to you at zero cost. Also, if you want to practically learn investing, you can consider joining my YouTube community, because almost on daily basis I speak about various assets, for example mutual funds, ETFs, stocks, and also bring you market insights so that you are a well-informed investor. The feedback of this community has been excellent. Simply go to my channel, find the join button and be my guest. Let me now show you exactly how to go about setting up a systematic transfer plan. So for this, I'm going to log in into Coin app by Zerodha. That's where I manage my mutual funds as of now. So what I'm going to do is simply going and selecting Coin app here. And here, first thing we will do is we will go into SIPs. You see on the top here, SIPs. Click on it. At the bottom, you will see SIP, SWP and STP here. STP is the one that we are after here, which is systematic transfer plan. Right now, I do not have any STP setup, but by the time we finish this process, the STP that we will set up will appear here and you are easily able to track it on. So the first step in creating STP is first to put our lump sum money into a overnight debt mutual fund. So for example, if you want to invest 10 lakh rupees lump sum, first step will be to find a overnight debt mutual fund and park that money into the overnight debt mutual fund. That is very, very simple. Go on to discover button here and you will see options here in terms of equity, debt, hybrid, etc. Click on debt and then you will see further options in the debt mutual funds. We are going to click on overnight debt mutual funds. You will see a lot of debt mutual funds coming up here. Why are we going with overnight debt mutual fund here? Couple of reasons that I think you need to understand. Reason number one, let me show you by clicking one of them. Let's say, let me click on SBI here, SBI overnight debt mutual fund. By the way, none of these are recommendations here, okay? What you note here is that last 3 years, this particular overnight debt mutual fund has generated 6.42% CAGR returns. Go back and have a look at, for example, ICICI, very, very similar returns, 6.45%. If you look at Axis, for example, 6.49%. Point is very, very simple that majority of the overnight debt mutual funds have given around 6.5% yearly returns in the last 3 years historically. What does this mean? That overnight debt mutual funds have generated better returns than the savings bank account, which gives you only 2 to 3%. So when we park our 10 lakh rupees here, that 10 lakh rupees money is immediately starting to work for you at a higher rate of return than savings bank account. Very, very important point. Point number 2 here is that if you go and click on any of these overnight debt mutual funds, you will note that exit load is 0% here, right? So tomorrow, if the market all of a sudden falls, and if you want to withdraw this 10 lakh rupees and were to buy the market dip, then there is no exit load here, 0%. Okay. Third point note here is the expense ratio. So in the case of SBI, it is 0.08%. Go and have a look at ICICI Pru, 0.08%. Have a look at Axis, 0.06%. Have a look at another one, HDFC, 0.1%. Point is very, very simple. The expense ratio is very, very low here, 0.06%, 0.08%. So you are actually not paying a lot of money for somebody to manage this overnight debt mutual fund for you. These are very, very cheap debt mutual funds. Now coming back, which debt mutual fund should you choose here? Please do not try to overcomplicate it. Go with what you like. Go with what AMC do you like. Go with the least expense ratio. Look at the AUM. For example, you might go with SBI, ICICI. There is also Zerodha somewhere here. Whatever you like, go with whichever one you like. Do not overcomplicate this step. For simplicity, I am going with SBI overnight fund here. Again, not a recommendation. I am simply showing this as an example in terms of how to go about setting it up. So let's say SBI overnight mutual fund. What we do here typically is buy here, and we are going to put our lump sum money. It could be any money that you want to invest. It could be, let's say, 1 lakh rupee, 5 lakh rupee, 10 lakh rupee. So let's say here I'm going and saying 10,000, 1 lakh and 10 lakh rupees here. And simply you make the payment. And what happens is, if you make this payment before 12:30 p.m. during the day, you are likely to get these units into your account the same day. So you have to wait for these units to arrive in this mutual fund before you can proceed to step number 2. So what I've done is I have made a payment of 5,000 rupees, right? And I've got that mutual fund in my coin application. Let me show it to you. And we are now moving to step number 2. From this mutual fund that we have bought just now, we are going to set up a systematic transfer plan. Now, once you get your units allocated and you see them on the coin app, for example, here I see SBI overnight fund, you can start with step number 2, which is to set up a systematic transfer plan. So for this, just click on this mutual fund, SBI overnight fund, and you will see 3 dots here. What you do is click on it, and then you will see a bunch of options. We are interested in STP, which is the systematic transfer plan. So click on it, and now it is asking you to set up a name. So you can give whatever name you like. For example, if you want to do 10 lakhs of transfer, so let's set up a plan for 10 lakhs here. Press on confirm button here. Now what you will see here is that out of the total 10 lakhs, so in my example, I only put in 5,000 rupees so that I can show you as an example. So what I can do is I can set up that you can withdraw, for example, every month 1,000 rupees. Okay. It could be any amount. So if you are doing 10 lakh rupees of lump sum investment, for example, what you can set up is that every month withdraw 1 lakh rupee, so that in the next 10 months, all your lump sum money will get distributed to your target mutual funds, right? So you can type out 1 lakh rupees here. In my example, since I just put in 5,000 rupees, I'm putting 1,000 rupees to withdraw here. And the next option here you will see is the frequency, meaning that how frequently you want this money to be withdrawn from your debt mutual fund and to be deposited into your target mutual funds. So here the options are, for example, you can do weekly, 15 days, monthly, quarterly. Weeklies will give you even a better average price if you want to go with it. In fact, if we had the option of daily, I would have preferred daily option. But let's say, for example, you want to go weekly, and here it shows you which day of the week. Again, choose any day, doesn't really matter because you're not going to time the market here. Simply you're saying, for example, you might say every Monday, take out 1,000 rupees from my debt mutual fund and then transfer it to my choices of mutual funds that I already hold. This is important. Before you set up the STP step number 2, you need to make sure that you have already bought those mutual funds. Even if you have bought one unit, that's fine because you're just setting up the STP plan here. So what we are going to do is selecting the transfer to mutual funds here. So when you click on it, you will see a lot of your mutual funds, right? You can decide which mutual funds you want to allocate this money. For example, I am going to select any from my profile here. Let's say this one, and for example, this one, and I can also select one of them. For example, let's go with this one here. You can select up to maximum 5 mutual funds here, which is more than enough in my view, right? Press on done button here, and these 3 mutual funds will come down here as you can see them here. Now you note here, it is also showing you the minimum amount here. that you need to invest in this particular fund, but you can change it, you can increase it. So if I am doing 1000 rupees here, which is potentially a wrong example, let's say if you were to do 1 lakh rupees distribution among these 3 mutual funds, you can enter the amount here. For example, 10,000 goes into this, and for example 80,000 can go in here, and for example remaining 10,000 can go in here. So you've done 10%, 80%, 10% allocation. The beauty of this option here is that you can set the transfer to mutual funds to any AMC. This is an industry first feature that I found on Coin, because if you go with any other AMCs, for example HDFC, SBI, they will not allow you to transfer out of their AMC to some other mutual funds when you set up a STP. But here on Coin, what I'm able to do is I can select from any AMCs. This is a beautiful feature in my view, because it allows you to go to any mutual funds of your choice as long as you already hold them in your portfolio. So simply here you can select these mutual funds. Now one thing you will note here is that the mandate. So if I click on mandate here, which is manage mandate. So what typically happens is that the way it works in the background, the STP plan here is that every week, for example, it is going to withdraw 1000 rupees from this debt mutual fund. That 1000 rupees will go into your bank account. Okay. And from that bank account, 1000 rupees that have been deposited, it will be then transferred to these 3 mutual funds, right? So for Zerodha or Coin app to take that 1000 rupees back from your bank account and distribute into these 3 mutual funds here, it needs a mandate, which is like a UPI mandate, for example. So what I have done is, if you click on manage mandate here, it will allow you to create a new mandate. Simply create a mandate, and you can using any UPI app, you can just create a mandate. Very, very simple process. I'm not going to show it to you here because I've already created a mandate. So here I'm going to select this mandate, and so for example, if I go back here, I have selected one mandate that I already had here. So it's a very, very simple process. Once you're done with this, what you can do is simply just go ahead and create the STP. The moment you create the STP, it will appear in the dashboard as I shown you. And this is where the entire process finished. I know it might sound slightly complicated, but believe me, once you set it up, it is going to work like a magic. Now, the last question you may ask me is, Rahul, how is STP different from SIP? Yes, you could have set up the SIPs as well, but the big difference between SIPs and STP is that when you do SIP setup, you are setting it up from your bank account. And that means that the lump sum money will lie in bank account and it will literally gather dust. Here in the method of STP, by putting the money into overnight fund, what you have done is you have generated far better returns than the savings bank return. And secondly, your money is not sitting in the bank account, because it is entirely possible that you might get a craving and you might spend that money before the SIP is finished. I have seen a lot of people doing that. Please don't do it. Follow this approach. This is not a new approach that I have advised or devised. People have been following this approach for a long, long time. It's just that now technology has made it really, really easy to set it up online in just few clicks. If you follow this entire process that I've walked you through, you'll be able to set up STP in just few minutes. So please make sure that if you're investing lump sum money, do not make this mistake of putting all your money in one go. It is not sensible at all. I've given you the example, I've shown you the data, and I've also shown you how to go about setting up STP. I hope you found this video useful. And if you did, like the button. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. Lastly, if you also want to practically learn investing, you can consider joining my exclusive YouTube community where I speak about various assets almost on daily basis. I hope to see you in my next video. Until then, keep rocking.